At this scale, time becomes the only way to visualize the numbers. Going back 1 million seconds lands roughly 11 days ago, 1 billion seconds, 32 years. But 1 trillion seconds rewinds the clock 31,000 years, before human civilization even existed. On June 12, 2026, the Nasdaq Stock Exchange in New York opened for trading. Within the very first second of a company called SpaceX going public, its owner, Elon Musk, became the world's first trillionaire. Yet the company propelling him to this milestone is operating deep in the red. In the year leading up to this initial public offering, SpaceX recorded a catastrophic loss of $5 billion. Musk's trillion-dollar status hides a lack of liquid cash. With only 0.1% of his net worth held in currency, his entire fortune consists of fragile paper wealth tied to Tesla and SpaceX shares. If he tried to sell those shares to get actual cash, the market would panic and the stock price would collapse. The valuation depends entirely on investors agreeing to maintain the illusion. Economists evaluate stock prices through 2 competing models. This diagram visualizes the firm foundation theory, which values a company based on the actual revenue and profit its factories produce, and the castles in the air theory, which drives a stock price up based on psychological hype and dreams of the future. When we look at the numbers, the imbalance is staggering. According to the research firm Morningstar, the fundamental value of SpaceX sits around $780 billion, but the market has pumped the valuation up to $2.2 trillion. Investors are buying into promises that routinely fail to materialize. High-speed hyperloops were promised in 2013 and quietly wound down a decade later. Fully autonomous robotaxis were promised within 3 years back in 2015, alongside realistic plans for human settlements on Mars within a decade. Investors are paying a premium to participate in a financial cult, prioritizing science fiction narratives over a functional, profitable business model. This makes the market valuation highly unstable. To turn that unstable paper wealth into usable cash, the ultra-rich rely on a specific tax avoidance strategy. This flowchart illustrates the 3 steps: buy, borrow, die. Capital gains taxes only apply when shares are sold, so Musk holds his overvalued stock indefinitely. When he needs money for living expenses or buying a massive platform like Twitter, he uses those shares as collateral to secure billions of dollars in low-interest cash loans from major banks. Because loan money is not legally classified as income, it isn't taxed. Between 2014 and 2018, Musk's wealth grew by $13.9 billion, yet he paid an effective tax rate of just 3.2%. The average American worker pays between 20 and 30%. This loophole allows billionaires to extract enormous purchasing power from hyped-up stock prices, while contributing almost nothing to the public tax base. The everyday working class is left to shoulder the economic burden of running the country. This borrowing system has a fatal flaw. If the stock price stops inflating, the banks call in their loans. When actual product deliveries fall short, billionaires turn to political power to manually force the market upward. During the 2024 election, Musk donated $290 million to Donald Trump's campaign. After Trump took office, Musk actively attended cabinet meetings and secured favorable deals during state visits to China and Saudi Arabia. Then the regulatory favors started rolling in. Historically, new companies launching an IPO had to wait months or years before being added to major indexes like the Nasdaq 100. This waiting period existed to protect regular investors. At SpaceX's request, the Nasdaq introduced a fast entry rule, shrinking that protection window to just 15 days. Just 2 days before the SpaceX IPO, the Securities and Exchange Commission issued a highly specific waiver. They excused brokers from the federal rule requiring them to keep their customers' cash in safe, separate accounts. The government actively removed the guardrails meant to protect the public, specifically to clear a path for massive amounts of unprotected retail capital to flow directly into a deeply unprofitable business. Because of that fast-track Nasdaq rule, index funds were forced to buy in. Millions of everyday Americans immediately had their retirement savings and pensions automatically dumped into SpaceX, whether they consented to it or not. By removing the broker separation rules, the SEC put over $70 billion of retail money in direct danger, entirely stripping away traditional safety nets to ensure Musk crossed the trillion-dollar threshold. Veteran investors see the writing on the wall. Steve Eisman, the analyst famous for predicting the 2008 economic collapse, described the SpaceX IPO as absolute madness, calling it tailor-made for a sci-fi cult. The foundation of this wealth is entirely dependent on political insulation. Musk admitted to Tucker Carlson that if Trump had lost the election, he would have been in a very bad situation. If political support shifts in 2028, analysts expect Musk's net worth to plummet. When a hype-driven valuation finally bursts, the financial fallout is never distributed evenly. The billionaires are protected by the loans they've already cashed out, while the retail investors who bought at the peak lose their life savings. Elon Musk's trillion-dollar net worth functions as a massive risk transfer machine. While the ultra-rich extract immediate liquidity, everyday investors are left holding the debt when the hype finally meets reality.